Hi. Let's learn about long straddle. A long straddle is an option strategy where the trader purchases both a long call and a long put on the same underlying asset with the same expiration date and strike price. The long straddle option strategy is a bet that the underlying asset will move significantly in price, either higher or lower. The profit profile is the same no matter which way the asset moves. Typically, the trader thinks the underlying asset will move from a low volatility state to a high volatility state based on the imminent release of new information. Long straddle positions have unlimited profit and limited risk. If the price of the underlying asset continues to increase, the potential advantage is unlimited. If the price of the underlying asset goes to zero, the profit would be the strike price less the premiums paid for the options. In either case, the maximum risk is the total cost to enter the position, which is the price of the call option plus the price of the put option. Many traders suggest an alternative method for using the long straddle might be to capture the anticipated rise in implied volatility. They would do so by initiating this strategy in the time period leading up to the event, say 3 weeks or more, but closing it just prior to the occurrence of the event. This method attempts to profit from the increasing demand for the options themselves, which increases the implied volatility component of the options themselves. Here are 4 key takeaways. 1. A long straddle is an option strategy that involves purchasing both a long call and a long put on the same underlying asset with the same expiration date and strike price. 2. The goal of a long straddle is to profit from a very strong move, usually triggered by a newsworthy event, in either direction by the underlying asset. 3. The risk of a long straddle strategy is that the market may not react strongly enough to the event or the news it generates. 4. An alternative use of the long straddle strategy might be to capture the anticipated rise in implied volatility, which would increase if the demand for these options increases. Hope this would help. Thanks for watching.